Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin. Welcome back. I appreciate you coming back and looking at the videos. Today I have a chart up of the S&P 500, and it's going back here to '07. And the reason I wanted to put this chart up is it's said that people in the market, they have short memories, and the longer, the further the distance you are away from some particular event or some particular market activity, the harder it is to remember, what happened and how you felt about it, and so on and so forth. So I wanted to put up the part of the chart that involved the financial crisis, what we now refer to as the financial crisis, because I want to just try to relate to everybody how deep this sell-off was and why it's so important for you to miss out on this type of thing if you're going to grow your wealth long term. So let's look at how far this was. So from about the high to about the low there was 57%. So 57%. So more than half of your account value got wiped out. And it's not so bad that if you held through that, obviously you've gotten it back and then some. But the point is, this type of drawdown is really best if you can avoid it. So, that's what the middle class investor is all about. This is why I wanted to do the YouTube channel. This bull market now that we've had has been going on for 5 years. There's a cycle to the market. We could go back and we could look at various cycle points in the market, and it would be obvious to you. So we just want to try to help give you the tools and the understanding to be able to make a decision if you choose to pull out and not live through this. Now, since we do have this longer term chart up, one of the things I want to point out is the market is this wedge here is what's known as a consolidation pattern. So the way the market works is there's disagreement, right? Some people say the market's going to go down. Some people say the market's going to go up. And this disagreement narrows and narrows and narrows and narrows over time. And so what happens is you start getting, there's an average through the middle of this, and then the standard deviation, or the distance away from the average, becomes narrower and narrower and narrower. So, or more and more narrow, I guess is proper English. So what does that mean? What's the big deal about that? Well, the market, because people are trading the market, there's if that price movement gets too narrow, eventually what happens is it tends to go one way or the other, and the reason is because the risk reward for the people, the traders in the market, the institutional traders that are in there, it's not great. It's if I can move from the mean up to a 2 standard deviation mark, for example, maybe that's only a 3% move, whereas over here it was a 15% move. So the profit, the ability to make money, gets smaller and smaller and smaller, and so eventually what happens is the market tends to break one way or the other. Now this is what's known as a rising wedge, and rising wedges, some percentage of the time, the number actually escapes me right now. It's not all that important, but a high percentage of the time they break to the downside. And what you can say about that is this distance, the fall, now not straight down, but it would work its way down, that distance would be approximately the distance at the beginning of the pattern. So something like this, from this 1064 to 671, if you mark that difference, that real number there, and you put it to here, you're talking about something down here or something like that. You're talking about, well, let's just measure it on this chart. This was almost a 39% move, 37% move, something like that. So that may be more than we want to take in our account. So we want to have a strategy for dealing with that. Now, let me apologize up front. My son tells me that I go, and I pause too much, and he wants me to rehearse a little bit more, but I just find that it's difficult for me to do that. So I apologize up front for going and pausing and stammering around. Just habit, I guess. I don't know. Not used to being on the radio or talking live. So back to the chart. A few weeks ago, we spoke about, if the market was pulling back, where would it likely pull back to? And we were talking about some possibilities. And if you recall, what we were talking about is I had a box. I think it was green at the time, but I had a box here on the screen, and I was explaining, although I probably didn't explain every detail, but what we look for is when the market makes a new high, or when it an important low. What we want to do is go back and look at the most recent, in this case, low. So what happened is the market came down to a low, and it ran up all the way here to a high. So when it starts to sell off, we say, okay, what was the most recent low? And it turns out this is an important low. It's more important than this low, because this is part of the correction here. This pattern right here. So this is the low we're interested in, and so the support is found from this low, and it's a zone just below this low. Okay, that's the significance of where I drew the box. Now, if the market comes down in such a way as to just come straight down, not straight down, but if it comes down and it moves through this box, then this box was not support. Now, I know that sounds kind of somewhat ridiculous, but the high probability assumption is that this will be support. In other words, the market, you need to learn kind of how to think in terms of probability. So the market moves up and down, but it moves from support to resistance, support to resistance, support to resistance, as it kind of meanders its way up or meanders its way down. So the high probability assumption, if you want to call it that, is that the market, it takes a breath, it pulls back into support, and then resumes the uptrend. So if it comes through this box and doesn't resume the uptrend, then this wasn't support. So what was it then? What can we say about it? Well, what we can say about it is that it's a deeper correction. Now, the problem with corrections is you don't really know, is it a correction, or is this whole pattern here, is this whole thing right here a topping pattern, setting us up for a new bear market? You don't really know. So this is why you got to try to have a strategy that allows you to make these decisions. But let's talk about what we can do if this happens. Okay, if we wake up, let's say next week or two, and we start hearing, or even next week, if we start hearing how the market sells off, and next thing you know, everybody's talking about it at work, and it's doing, it's going down. Okay. Now the good news is the market, it doesn't just go down all the way down, right? It goes to the next level of support. Okay. So where is that next level of support? Well, it turns out that where it is right in this area right here. So what it would do is it would come down. Now it would meander down a little bit. It wouldn't come straight down, but it might come down into this area right here, actually above this high. Or excuse me, I'm sorry, I misspoke. I'm lost myself in the chart here. Actually, what it would do is it would come down, and there would be another box like just off of this low. So if we were to back up and look at the, let me back up here a second, and so remember how I talked about this move up right here was off the previous low, and so the last low into this high was important. Well, if you look at now this move, so you just back up and you look at a new section of this chart. So if you thought of this whole line as the move up into this area, then this next area would be the next level of support. Okay, so what's likely to happen, let me give myself some room here. So what's likely to happen if it comes through this level of support is you just go down to a new level of support. So you would come down, let me draw this box here. There would be a level of support like right in this zone. Kind of right here to right here, let's say. So this is going to come down something like this, and then it would start to kind of meander back up like so, like this. So let's just assume for a second that the market comes through our level of support and it is panic all the way down to this 1700. So, you know, if you were in this market in a 401k and it was at 1884 and you sold off all the way to 1700, you're thinking, okay, well, I just lost 10% in my account. It's not the end of the world, but it's also not a place to panic and make a decision that's not a good decision. So what can we do here? Well, we could wait until this comes back up, okay, which it would probably do. Probably this wedge, it would probably test the underneath side of this wedge. This is very typical of the market, okay? And what you could do is, depending on what it does here, you could make a decision. Let's say it just kind of, you did a bunch of this. You might say, you know what, I just don't like this market. I'm going to step aside. And then, you know, if it starts to move back up, you can always get back in. But if it starts to go down, you're like, whew, I saved myself. You know, a lot of heartburn there. So that's kind of something you can do. But the key is watch these levels of support, okay? Again, the market doesn't go straight down. So you don't have to, if you're right in here, yeah, your account's going to keep going down, but you don't have to make a decision in the middle of this move here. You can wait until you get something like this back up, you know, to where it tests the underneath side of this thing. In fact, let me show something real quick here. There's something in the charts, in the tools, if you have a charting software called Fibonacci retracements. So assuming it went, let's draw a fictitious line down here. Let's say it went to right there, okay, which is within the zone of the box. And we wanted to kind of know, well, you know, how far might it go back up, or where's a good place to get out if it goes back up? Well, you could do what's I'm sorry, I did that wrong. You could do a Fibonacci. You could go to the previous high and down to this low. And Fibonacci, it's just a special numbering ratio that tells you where likely places are that the market's likely to travel to. So if it went through support and came all the way down to this 1725 area, you might expect it to actually return somewhere in between this 50% and 62% area retracement. So if you decided that's where you wanted to step aside, then you might wait till it moves back up. That's one strategy. There's a number of different strategies you can use. What you're trying to avoid, though, is let me put a little bit more time on here. What you're trying to avoid is you're trying to keep from having to, you know, deal with something that looks like this. I mean, down, and then back up, and then a lot of times this, once you retest the underneath side of something, this next move down is really significant. I mean, this will make you wish you'd taken some action. In fact, let's go back and look at, because the market really does repeat itself pretty much over and over again. And the market's just people, right? There's just people that cause this trend action to happen. And so I tell you what, let's back up, look at it from a distance. So you can see, let's say this is this area right here is the first move down, and then you have this retrace. See how much longer this move is right here? Or in this one, look at this. Pretend like this is the first move down, and then look how much longer this move is right here. This is pretty typical. So think of it as like, you remember we talked about the spring is coiling up? Well, this is the spring unwinding. Okay, this is people unwinding their positions and selling, and they're actually selling to get out. They're actually having to hit bids below where the market prices are, and it's like a panic, right? So it drives market prices lower. So ideally what you want to do is be able to make your decision up here where the moves, yeah, they're big, but they're not near as big as these, okay? And then you can look for kind of bottoming action. What does bottoming action look like? It looks like this. See right in here? This is bottoming action. So when you get kind of a bottoming action in the market, that's when it's time to step back in and move on. Now, this bottom was a very unusual type bottom, very, very abrupt. And here you would have just had to wait for confirmation. You would have had to, like on a weekly chart, let's say, you would have had to wait. Let's zoom in on this and so I can help you understand. You had this dive down in here, and if this was a bottom, you could say, well, if I had 2 weeks in a row that went above this high section right here, then I say, well, let me go ahead and get in. So you'd have to have 2 weeks in a row, let's say, back to back. So in this week right here, you couldn't call this a bottom because here's your first week above the high, but then look, the next week was actually lower. So that's a no. That's a not let's get in yet. Then it came back. I mean, you could use a simple little rule like this. Have it pull to a low. My first week is higher than that previous week's high, and the second week was also higher. So I'm going to go ahead and get back into my 401k. In this case, that would have worked. So you just have to have a strategy for getting back in. If either you're wrong or you get a really abrupt looking bottom like this. In the weeks and months ahead, we're going to talk more and more about this stuff. It's very important. This rally is very long in the tooth. If we go back, if we go back a little further, let's measure this one right here. This was when George Bush was in office. So this is 9/11 happened right around in this area, right about in here somewhere. So George Bush was president, and then we had this run up, and then we had the financial crisis, and now President Obama's president, and we've had this run up. So let me just measure this for you. And the business cycle is kind of the business cycle. There's not much you can do about it. There's a lot of moving parts there. That was 1,820 days, this run up from here to here. And the most recent run up that we've had over here in the last bit of bull market, I think it's actually more than that, which is probably has to do with the Fed. And this one's 1,846 days. So far about a month longer than the rally up under George Bush. So, it's time to, there's yellow lights, okay? The people on TV are saying this is going to go much higher. Yeah, maybe so. I mean, certainly if you're in the market, you want to stay in the market until it gives you a reason to get out. And the reason to get out is potentially what we talked about just a few minutes ago, where you get a sell-off, blows through this support. The reason that's important, because if it goes through this support and comes all the way down, oops, hold on, I'm sorry. If it goes through this level of support right here, and goes down to this level of support, it will have broken this wedge pattern. Okay, that's why that's important. Actually, this will be one of the easiest bear markets to avoid in history, almost, because if you get a signal that says, if you see the market move through this level of support and break the lower trend line of this wedge and come down to this level of support and retest, that's a very high probability that it's going to retest this line and then sell off. And that's going to be one of the easiest bear markets to spot in history. Nobody should lose money. Certainly that's the goal of the middle class investor, and that's what I want to help people do. If you choose to do it, look, you don't have to do what I'm talking about doing. You can sit there and wait it out and listen to the broker and have him tell you that you're in it for the long haul and you're young and nobody can time the market and all that kind of cliche stuff. But I'm just telling you, when these patterns mean something, and you got to look out for them. Does it mean that it has to happen? No, it doesn't mean that it has to happen. But the thing about the market, you got to remember, is everybody's kind of looking at the same thing. So when people see this, the people that understand, when they see a break of support and a retest underneath, they're all looking the same thing. They're all thinking the same thing. And the market is just a bunch of people, negotiating the price of something. That's all it is. So in the days and weeks ahead, we're gonna talk more about this, and we're gonna have a little fun doing it. Hopefully, all you guys out there will be geniuses, and you'll be able to tell your friends that, yeah, I missed all that, and I'm sleeping like a baby, and that kind of stuff. That's my greatest hope for all of you. So keep tuning in, keep coming back, tell your friends about it. Maybe forward them the link. Subscribe to the channel. There's a button where you can like underneath the video. It's on the left. You can like, and you can also subscribe if you have a YouTube account. And the subscribe is nice because then you can just, it's easy to see when there's new videos and stuff. It'll actually tell you there's new videos. So anyway, thanks for coming back, and we'll see you guys in, a few days, maybe midweek next week. Thanks for coming. See you soon. Bye-bye.